On the evening of August 15th, 1971, most Americans were settling in for a quiet Sunday night. Some were watching Bonanza. Others were flipping through the newspaper. Kids were dreading the return to school. Nobody was thinking about money. But at that exact moment, in a room at Camp David, 15 men were about to change the rules of the American economy forever. And not a single citizen had voted for it. Not a single newspaper had reported it. Not a single person outside that room knew it was coming. What happened that night would determine the value of every paycheck you've ever earned, every house you've ever tried to buy, every dollar sitting in your bank account right now. President Nixon called it a temporary measure. It's been 55 years. The temporary measure is still in effect. And here's what they never taught you in school. That single weekend decision is the reason a house costs 7 years of income instead of 4. It's the reason your grandparents could raise a family on 1 salary while you struggle on 2. It's the reason the American middle class has been slowly hollowing out for half a century. This isn't conspiracy. I'm not going to tell you the Illuminati controls the money supply, or that shadowy figures are plotting your financial destruction. This is documented history. This is Federal Reserve data. This is what actually happened, and what's still happening, while most people have no idea. In 2026, the consequences of that temporary experiment are accelerating faster than at any point in the last 5 decades. Gold just hit all-time highs, above $4,600 an ounce. The national debt is growing at $70,000 per second. Central banks around the world are hoarding gold at rates not seen since the 1960s. Something is happening, and it all traces back to that quiet Sunday night in 1971. By the end of this video, you'll understand exactly what Nixon did, why he did it, and why it matters more today than at any point since that fateful weekend. You'll understand why everything feels more expensive, even though you're working harder than your parents did. And you'll have a framework for understanding what comes next. Let's start with what the world looked like before that Sunday night changed everything. To understand what Nixon destroyed, you first need to understand what existed before. In July 1944, as World War II was grinding toward its conclusion, representatives from 44 nations gathered at a resort in Bretton Woods, New Hampshire. Their mission was ambitious: design a new global monetary system that would prevent the chaos that had led to 2 world wars. The system they created was elegant in its simplicity. Every country would peg its currency to the US dollar, and the US dollar would be pegged to gold at a fixed rate of $35 per ounce. This meant something profound. If France accumulated dollars through trade, they could exchange those dollars for gold at any time. The United States had made a promise to the world. Our currency is as good as gold, literally. For the first 2 decades, this system worked beautifully. America had emerged from the war with the largest gold reserves on the planet. We were the manufacturing powerhouse of the world. Dollars flowed out through trade and foreign aid, and gold sat securely in Fort Knox, backing every single one of them. But here's the thing about promises. They're easy to make. They're harder to keep. By the 1960s, cracks were forming. President Johnson was fighting an expensive war in Vietnam. He was funding ambitious social programs at home. And both required money that America didn't actually have. So the Federal Reserve did what central banks do when governments spend more than they collect. They printed more dollars. The math problem was simple and devastating. In 1944, the dollars in circulation roughly matched the gold available to back them. By 1971, there were 4 times as many dollars circulating as there was gold in the reserves. The promise was becoming impossible to keep. Foreign nations noticed. France, in particular, began demanding gold for their dollars. Charles de Gaulle sent a warship to New York to collect French gold and bring it home. Other nations followed. The drain was relentless. At the peak, America held over 20,000 metric tons of gold. By August 1971, that number had been cut in half. 10,000 metric tons remained, and it was disappearing fast. Now, here's where most history books stop. They tell you Nixon closed the gold window to protect American interests. End of story. But the real story is what happened inside Camp David during those 3 days in August. And it involves a cast of characters whose decisions still shape your financial life today. There was Arthur Burns, the chairman of the Federal Reserve, who had warned that abandoning gold would unleash inflation. He was overruled. There was Paul Volcker, the Undersecretary for International Monetary Affairs. He would later become Fed chairman himself and impose 20% interest rates to fight the very inflation that Burns had predicted. And then there was Treasury Secretary John Connally, a Texas politician with supreme confidence and a gift for memorable phrases. When European finance ministers complained about the falling dollar, Connally famously told them, "The dollar is our currency, but it's your problem." That attitude defined the Camp David decision. On the evening of August 15th, Nixon went on television and announced what he called the new economic policy. He was suspending the convertibility of dollars into gold. He framed it as protecting America from international speculators. He promised it was temporary. The gold window has never reopened. Now, I need to introduce you to someone who saw all of this coming. Someone whose framework for understanding money and risk is more relevant today than ever. His name was John Exter, and his story is crucial to understanding what happens next. Exter was not some fringe commentator or gold bug conspiracy theorist. He was a member of the Board of Governors of the Federal Reserve System. He founded the Central Bank of Sri Lanka. He was the ultimate monetary insider. And in the 1970s, he created something called the inverted pyramid of risk. Picture an upside-down pyramid. At the very bottom point sits gold. Physical gold. The only financial asset in existence with no counterparty risk. It doesn't require anyone else to honor a promise. It simply is. Above gold sits cash and paper currency. Above that, government bonds. Then corporate bonds. Then real estate and stocks. And at the very top, the widest part of the inverted pyramid, sits the most speculative and risky assets of all, derivatives and complex financial instruments. Exter's insight was this. In times of stability and confidence, money flows upward in the pyramid. People take more risks. They buy stocks and speculate on derivatives. They chase yield. But in times of crisis, something different happens. Capital flows downward. It seeks safety. It moves from speculative assets toward government bonds, then toward cash, and ultimately toward the very bottom of the pyramid, toward gold. Exter watched Nixon close the gold window and understood exactly what would follow. He predicted that without gold's discipline, the United States would print unlimited amounts of money. Debt would explode. The purchasing power of the dollar would collapse over time. He positioned himself accordingly. He bought gold before Nixon's announcement. He made a fortune as gold rose from $35 to over $800 per ounce by 1980. But here's what made Exter different from the doomsayers. He wasn't predicting the end of the world. He was simply understanding the system. He recognized that removing gold from the equation didn't eliminate the laws of economics. It just delayed the consequences. And those consequences, he believed, would compound over time until they became impossible to ignore. 55 years later, we have the data to evaluate his prediction. The numbers are staggering, and they affect every single person watching this video. But here's what made this different from every other economic decision in American history. Previous changes to the monetary system had been debated in Congress. They had been covered by newspapers. Citizens understood, at least roughly, what was happening to their money. The Nixon shock happened over a single weekend. It was presented as a technical adjustment. Most Americans went back to watching Bonanza and never thought about it again. Meanwhile, the experiment had begun. An experiment in running the world's reserve currency without any anchor to physical reality. An experiment in trusting politicians and central bankers to show restraint when they could print money without limit. An experiment in whether a financial system built on promises could survive indefinitely. That experiment is still running today. And the results are coming in. The morning after Nixon's announcement, the world woke up to a different monetary reality. Most people didn't notice. The sun still rose. Paychecks still cleared. Grocery stores still accepted dollars. But something fundamental had shifted. The anchor was gone. And over the next 55 years, that absence would reshape everything. Let me walk you through what happened in 3 distinct phases, each one built on the last. Each one brought us closer to where we stand today. Phase 1 began immediately and lasted through 1980. Economists call it the Great Inflation. I call it the first warning sign that everyone ignored. Within months of Nixon's announcement, the dollar began falling against other currencies. Gold, which had been fixed at $35 for decades, started climbing. First to $40, then $50, then $100. By 1974, inflation hit 11%. By 1980, it peaked at over 14%. The purchasing power of the dollar was evaporating in real time. Think about what that means practically. If you saved $10,000 in 1971, planning to buy a house or fund retirement, that money lost nearly half its value in less than a decade. Not because you made bad investments, not because you did anything wrong, simply because the rules had changed without your consent. The Federal Reserve, the very institution that had enabled the money printing, now had to clean up the mess. Paul Volcker, the same man who had been in that Camp David room, became Fed chairman in 1979. His solution was brutal. He raised interest rates to 20%. 20%! Mortgages became unaffordable. Businesses couldn't borrow. Unemployment soared. The economy plunged into the deepest recession since the Great Depression. But it worked. Inflation was broken. By the mid-1980s, prices stabilized, the economy recovered, and most Americans breathed a sigh of relief, believing the crisis was over. It wasn't over. It had just entered a new phase. And this is where it gets personal. Because everything I just described, you felt it. Maybe not consciously, maybe not with the vocabulary to explain it. But the consequences of what happened next have shaped your entire economic life. Phase 2 ran from roughly 1980 to 2008. Economists call it the Great Moderation. Inflation stayed low. Growth was steady. Stock markets boomed. It looked like we had figured out how to run a monetary system without gold. But something else was happening beneath the surface. Something that wouldn't become obvious until much later. Debt was growing. Quietly, relentlessly, exponentially. In 1971, the total national debt stood at about $400 billion. By 1980, after the inflationary crisis, it had reached $900 billion. Still manageable. Still within historical norms. But then, something changed. Without gold's discipline, without any external constraint on spending, the debt began its exponential climb. $1 trillion by 1982, $2 trillion by 1986, $3 trillion by 1990, $6 trillion by 2002. The pattern was unmistakable. Every decade, the debt roughly doubled. The temporary measure had become a permanent addiction. Meanwhile, something was happening to ordinary Americans. The middle class, that backbone of the American economy, began its long, slow contraction. In 1971, 61% of American adults lived in middle-income households. This wasn't a golden age myth. This was Census Bureau data. Nearly 2/3 of the country occupied that stable economic middle ground. By 2000, that number had fallen to 54%. Not a collapse, not a crisis, just a slow, steady erosion that most people didn't notice year to year. But the data tells an even more disturbing story when you look at where the money was going. In 1970, middle-income households earned 62% of all income in America. The middle class wasn't just numerous, it was prosperous. It captured the majority of economic output. By 2000, that share had fallen to 46%. The middle class was shrinking, and its slice of the pie was shrinking faster. Where was the money going? Upward. The share captured by upper-income households grew from 29% to 45% during the same period. This wasn't because rich people were working harder. It wasn't because poor people were lazier. The rules of the game had changed. Asset prices were rising faster than wages, and assets were concentrated at the top. Think about housing. In the early 1970s, the median home cost about 3.7 years of median income. A family could realistically save for a down payment. A single earner could afford the mortgage. By 2000, that ratio had climbed to nearly 6 years of income. By 2024, it reached 7.6 years. Homes weren't getting that much better. Wages weren't falling in nominal terms. But the relationship between work and ownership was fundamentally breaking. This is the hidden tax of the post-1971 system. You don't see it on your paycheck. No politician votes on it. But every year, the gap between what you earn and what things cost grows a little wider. Now, here's what John Exter saw coming that almost everyone else missed. Remember his inverted pyramid. Gold at the bottom, derivatives at the top. Capital flows up in good times, down in bad times. After 1971, with no gold anchor, something unprecedented happened. The pyramid started growing, rapidly, in directions Exter could barely have imagined. In 1971, global derivatives barely existed as a category. By 2000, the notional value of derivatives contracts exceeded $100 trillion. By 2008, that number had grown to over $600 trillion. $600 trillion. That's roughly 10 times the entire global GDP. 10 times the value of everything produced by every human on Earth in a year. Most of these derivatives were financial instruments built on other financial instruments. Promises built on promises built on promises. The pyramid was growing top-heavy in ways that defied comprehension. Exter had warned that this structure was inherently unstable, that eventually confidence would crack, that capital would rush downward towards safety. In September 2008, he was proven right. Lehman Brothers collapsed. The global financial system froze. Trillions of dollars in derivatives became worthless overnight. Banks stopped trusting each other. Credit markets seized. For a few terrifying weeks, it looked like the entire pyramid might pancake. Capital fled from complex instruments, then from corporate bonds, then from anything that carried counterparty risk. Gold, which had been trading around $800, spiked as money rushed towards the bottom of Exter's pyramid. But here's where the story takes its most consequential turn. The response to 2008 set up everything that's happening today. The Federal Reserve, facing a complete systemic collapse, did something it had never done before. It created money on a scale that would have been unthinkable just years earlier. They called it quantitative easing. The mechanics were complex, but the essence was simple. The Fed created new dollars electronically and used them to buy bonds and mortgage securities. Trillions of dollars, conjured from nothing. Between 2008 and 2014, the Fed's balance sheet grew from around $900 billion to over $4 trillion. They had more than quadrupled the monetary base in 6 years, and then interest rates went to zero, and stayed there, for nearly a decade. This was the emergency response, the extraordinary measure, the temporary intervention to prevent collapse. Temporary. That word again. Phase 3 began in 2008 and continues today. I call it the Great Acceleration, because everything that had been building slowly for decades suddenly shifted into a higher gear. The national debt, which had taken 200 years to reach 10 trillion, added another 10 trillion in just 8 years. By 2016, it stood at 20 trillion. By 2020, 27 trillion. Today, it exceeds 38 trillion. These numbers are so large, they lose meaning. So let me make them concrete. The debt is currently growing at approximately $6 billion per day. That's $255 million per hour. $4.25 million per minute. $70,000 per second. Every second you've been watching this video, the national debt has grown by roughly $70,000. By the time you finish, it will have grown by millions more. But debt is only half the story. The other half is what happened to everyone else. The middle class continued its contraction. From 54% in 2000 to 50% by 2023, half the country, down from nearly 2/3 just 5 decades earlier. More importantly, the middle class share of total income kept falling, from 46% in 2000 to just 42% by 2020. Meanwhile, the upper income share rose to 50%. For the first time in modern American history, the top tier captured more income than the entire middle class combined. Housing became effectively unaffordable for average workers in most major cities. The ratio that once stood at 3.7 years of income now exceeds 12 years in Los Angeles, nearly 11 years in San Jose, almost 10 years in New York. And that brings us to the turn, the moment where the pattern becomes undeniable. Because while most Americans were struggling with these realities, another group was paying very close attention. A group with resources and information that ordinary people don't have. Central banks around the world started doing something remarkable. Quietly. Systematically. In volumes not seen since before, Nixon closed the gold window. They started buying gold. In 2022, central banks purchased over 1,100 tons of gold. It was the highest annual total since 1967, the year before Nixon's announcement. In 2023, they bought over 1,000 tons again. In 2024, over 1,000 tons again. 3 consecutive years of extraordinary accumulation. Poland, China, India, Turkey, Singapore, Kazakhstan. Nations across every continent with different political systems and economic philosophies, all reaching the same conclusion. They were moving down Exter's pyramid. The question is, what do they know that you don't? Let me show you something that will change how you see everything. I'm going to put 2 sets of numbers side by side. The first set is from 1971, the year Nixon closed the gold window. The second set is from today. And when you see them together, the pattern becomes impossible to ignore. Middle class share of population. 1971, 61%. 2023, 50%. 11 percentage points gone. 1 in 5 middle-class Americans, statistically speaking, no longer exists in that category. Middle-class share of total income. 1970, 62%. 2020, 42%. 20 percentage points transferred. The majority became the minority. House price to income ratio. 1971, 3.7 years. 2024, 7.6 years. More than doubled. What took 4 years of work now takes nearly 8. Dollar purchasing power. 1971, $1. 2026, 12.5 cents. That's not a typo. $1 today buys what 12.5 cents bought in 1971. The other 87.5 cents simply vanished. Gold price. 1971, $35 per ounce, fixed by law. January 2026, over $4,600 per ounce, a 130-fold increase. Not because gold became more valuable, but because dollars became worth less. National debt. 1971, $400 billion. 2026, $38.4 trillion. Nearly 100 times larger. Every man, woman, and child in America now owes over $112,000. Now, I want to be very clear about something. I'm not here to tell you the dollar will collapse tomorrow. I'm not selling you gold coins or survival bunkers or cryptocurrency schemes. What I am telling you is this. These numbers are not random. They are not coincidence. They are the documented, measurable, undeniable consequences of a decision made over a single weekend in 1971. The temporary measure that was never reversed. And here's the part that should really get your attention. The people who manage the world's money, the central bankers who understand these systems better than anyone, are acting like something has changed. For most of the past 50 years, central banks were net sellers of gold. They viewed it as a relic, an outdated artifact of a monetary system we had evolved beyond. They sold their reserves and bought treasury bonds instead. That trend reversed dramatically. In 2010, central banks became net buyers for the first time in decades. And they haven't stopped since. 15 consecutive years of accumulation. But it's the recent acceleration that tells the real story. In 2022, central banks purchased 1,136 tons of gold. It was the highest single-year total since 1967, 1 year before Nixon's announcement. Think about that timing. The last time central banks bought this much gold, they were preparing for the end of Bretton Woods. They saw what was coming and positioned accordingly. In 2023, They bought over 1,000 tons again. In 2024, over 1,000 tons again. 3 consecutive years above that threshold. The pattern is unprecedented in modern history. Poland has been particularly aggressive. They've more than doubled their gold reserves since 2018. The central bank governor announced a target of 20% gold in total reserves. They've already exceeded it. China has added gold for 18 consecutive months. Their official reserves now exceed 2,200 tons, though many analysts believe the true number is significantly higher. India, Turkey, Singapore, Czech Republic, Qatar, Uzbekistan. The list spans every continent and every political system. These nations agree on almost nothing, but they all agree on this. They're buying gold. They're moving down Exter's pyramid. The question isn't whether they know something. The question is what they know, and whether you'll understand it before it matters. But when you see what's happening right now, in 2026, you'll understand why this matters more than ever before. Let me bring you to the present moment, January 2026, and let me show you why everything we've discussed is accelerating. Start with the debt, the number that underlies everything else. As of this month, total U.S. national debt stands at $38.43 trillion. I want you to understand how fast this is growing. The debt increases by roughly $6.17 billion every single day. That's $257 million per hour, $4.29 million per minute, $71,461 per second. While you've been watching this video, the debt has grown by approximately $2 million. By the time you go to sleep tonight, it will have grown by another $6 billion. At this pace, we'll hit $39 trillion by April, $40 trillion before the end of the year. These aren't projections based on assumptions. This is simple math based on current trajectory. But the debt itself isn't the crisis. The crisis is what it costs to service that debt. In fiscal year 2025, the federal government spent $952 billion just on interest payments. Not paying down the debt, not funding programs, just interest. That's more than we spent on Medicare, more than we spent on national defense. Interest on the debt is now the second largest line item in the federal budget, behind only Social Security. And it's growing. In the first quarter of fiscal 2026, interest payments hit $179 billion. That's 13% higher than the same period last year. The math is becoming impossible. We're borrowing money to pay interest on money we already borrowed. This is the debt spiral that economists have warned about for decades. It's no longer theoretical. Now layer on what's happening globally. And here's where it gets really interesting. Because what's happening now isn't random. It's a coordinated shift that's been building for years. BRICS. You've probably heard the acronym. Brazil, Russia, India, China, South Africa. The original 5 members of an economic alliance formed in 2009. In January 2024, that alliance expanded. Egypt, Ethiopia, Iran, and the United Arab Emirates joined as full members. Indonesia joined in 2025. 13 additional nations signed on as partner countries. The expanded BRICS now represents over 40% of global GDP when measured by purchasing power. They control roughly half of the world's population. They include some of the largest oil producers on the planet, and they've been openly discussing alternatives to the dollar. At the 2024 summit in Kazan, Russia, member nations discussed BRICS Pay, a decentralized payment messaging system designed to facilitate trade in local currencies. At the same summit, Putin appeared on stage, holding what looked like a prototype BRICS banknote. Now, I need to be fair here. The BRICS currency hasn't materialized. Putin himself stated in November 2024 that Russia wasn't seeking to abandon the dollar. India has explicitly distanced itself from de-dollarization goals. Internal disagreements, particularly between India and China, have slowed progress. The July 2025 summit in Rio produced no concrete progress on a shared currency. The dream of a unified BRICS monetary system remains just that, a dream. But here's what is actually happening. bilateral trade in local currencies is expanding rapidly. China and Russia now conduct over 90% of their bilateral trade in yuan and rubles. Brazil and China signed a yuan-real settlement agreement. India purchases Russian oil in rupees. The dollar isn't being replaced. It's being routed around. Slowly, incrementally, but measurably. In the 1970s, the dollar represented 85% of global foreign exchange reserves. Today, that share has fallen to approximately 58%. Still dominant, still the world's reserve currency. But the trend line points in only one direction. Remember Exter's pyramid? Watch where capital is flowing. Gold just had its best year since 1979, a 65% gain in 2025. The price broke through $3,000 per ounce in March. It broke $4,000 in October. As of this week, it sits above $4,600. This isn't speculation driving the rally, it's institutional accumulation. Central banks buying over 1,000 tons per year. Exchange-traded funds seeing record inflows. Physical demand from China and India reaching historic levels. Gold has now overtaken the euro as the second largest reserve asset globally, representing roughly 20% of total central bank reserves. The trend that started after 2008 has accelerated into something that looks structural rather than cyclical. And it's not just central banks. Wealthy individuals and family offices have quietly increased their gold allocations. The demand for physical metal, not paper contracts, has created premiums in some markets. Delivery times have extended. The paper gold market trades over $80 billion daily, but the actual physical gold available for delivery is a tiny fraction of that. The ratio of paper to physical trading exceeds 100 to 1. This is Exter's pyramid in microcosm. Promises built on promises, resting on an ever smaller foundation of real metal. So, what does all this actually mean? Let me show you the implications. For the ordinary American, the one trying to buy a house and save for retirement, and maybe put kids through college, the last 55 years have been a slow-motion wealth transfer. Not through conspiracy, not through malice. Through the simple mathematics of a system that debases currency while inflating assets. If you owned assets, particularly stocks and real estate, the post-1971 era made you wealthy. The S&P 500 has risen over 5,000% since the gold window closed. Real estate in major cities has appreciated even faster. If you relied on wages, you fell behind. Productivity has risen steadily since 1971. Output per worker has nearly doubled. But wages, adjusted for inflation, have barely budged for the bottom 60%. The gains went to asset owners. The losses fell on wage earners. This wasn't a bug in the system. It was a feature, a direct and predictable consequence of removing the golden anchor. Your grandparents could raise a family on a single income because the relationship between wages and prices was stable. That stability existed because the dollar was tethered to something real. Your parents needed 2 incomes to maintain the same standard of living. You might need 2 incomes, plus side hustles, plus strategic debt management. Your children may find even that insufficient. This is the experiment. This is what Nixon's temporary measure has produced over 55 years. Not collapse, not apocalypse. Just a slow, steady erosion of purchasing power that transfers wealth upward while leaving most people running faster to stay in place. The dollar isn't dying dramatically, it's dying gradually, 1% at a time, year after year, decade after decade. And in 2026, the signals suggest that gradual process may be accelerating. Gold at all-time highs. Debt growing at $70,000 per second. Interest payments consuming nearly $1 trillion annually. Central banks hoarding gold at rates not seen since the 1960s. Foreign nations building alternative payment systems. None of this guarantees collapse. The system has proven remarkably resilient. Those predicting imminent dollar death have been wrong for decades. But the trends are undeniable. The mathematics are inescapable. And the people who understand money best are clearly repositioning. The question isn't whether you should panic. Panic helps no one. The question is whether you understand what's happening. and whether that understanding will inform how you navigate what comes next. So where does this leave us? After 55 years of the experiment, after trillions in debt and an 87% loss in purchasing power, what actually happens next? I'm going to give you 3 scenarios, not predictions. Scenarios. Because anyone who claims to know exactly how this ends is either lying or delusional. The future is genuinely uncertain, but these are the 3 most likely paths based on historical precedent and current trajectory. Scenario 1. The muddle through. This is the consensus view among mainstream economists. The dollar remains dominant, but gradually weakens. Inflation stays elevated, but manageable. Living standards slowly erode while the system continues functioning. Under this scenario, nothing dramatic happens. No collapse, no reset, just more of what we've experienced since 1971. Homes become slightly less affordable each decade. Wages fall slightly further behind productivity. The middle class continues its slow contraction. The system survives because there's no viable alternative. The euro has its own problems. The yuan isn't freely convertible. Gold can't handle modern transaction volumes. So the dollar wins by default, not by merit. This scenario is entirely plausible. The system has defied skeptics for 5 decades. It could defy them for 5 more. Scenario 2. The managed transition. Under this scenario, policymakers recognize the unsustainability of current trends and engineer some form of monetary restructuring. This could involve digital currencies, partial gold backing, a basket of reserve currencies, or something entirely novel. There's historical precedent. Bretton Woods itself was a managed transition from the previous gold standard. It was negotiated over years, implemented deliberately, and provided decades of relative stability. A modern equivalent might emerge from necessity, when interest payments consume 30% of federal revenue instead of 15%, when foreign nations stop buying treasury bonds, when the mathematics become impossible to ignore. This transition would be disruptive. Savers might see their purchasing power adjusted overnight. Debtors might find their obligations restructured. But if managed competently, civilization doesn't collapse. The economy adapts. Life continues. Now, some will say I'm being alarmist, and they have a point. But consider this. Scenario 3. The crisis-driven change. This is John Exter's warning scenario, the one he saw coming 50 years ago. Under this path, confidence breaks before policymakers can act. It might start with a failed treasury auction, or a sudden loss of faith in sovereign debt, or a geopolitical shock that accelerates capital flight. The trigger is unpredictable. The response is not. Capital rushes down the pyramid, first from derivatives and speculative assets, then from corporate bonds, then from anything with counterparty risk. The flight to safety becomes self-reinforcing. In this scenario, those holding paper promises watch their wealth evaporate. Those holding real assets, particularly gold at the bottom of Exter's pyramid, see their purchasing power increase dramatically. This isn't apocalypse. It's happened before. Weimar Germany, Zimbabwe, Argentina, Venezuela. Currencies have collapsed throughout history. Society survived. But wealth was transferred violently from those who didn't understand to those who did. I'm not telling you this will happen. I'm telling you it could happen. And the people running central banks around the world, the ones buying 1,000 tons of gold every year, seem to be hedging against exactly this possibility. And that brings us to the question you're probably asking. What do you actually do with this information? I can't give you financial advice. I'm not qualified, and it wouldn't be appropriate. But I can tell you what I've learned from studying this for years. Understanding is the first step. Most people go through life completely unaware that the rules of money changed in 1971. They feel the consequences without comprehending the cause. They blame themselves for falling behind when the system itself was tilted against them. You now know something most people don't. That knowledge won't pay your bills. But it might change how you think about savings, debt, assets, and the future. The second step is recognizing that this isn't about doom. It's about transition. Every monetary system in history has eventually ended. The gold standard ended. Bretton Woods ended. Whatever comes after the current system will eventually end too. The question isn't whether change comes. The question is whether you'll be positioned for it when it does. Let me take you back to where we started. August 15th, 1971. A quiet Sunday evening. Americans watching television. Children dreading school. Nobody thinking about money. And in a room at Camp David, 15 men making a decision that would shape the next half-century of economic life. They didn't ask permission. They didn't hold hearings. They didn't warn anyone. They simply announced that the rules had changed and expected everyone to adapt. Nixon called it temporary. 55 years later, the gold window remains closed. The debt stands at $38 trillion and growing by $70,000 every second. The dollar has lost 87% of its purchasing power. The middle class has shrunk from 61% to 50% of the population. And gold, the barbarous relic that sophisticated economists dismissed for decades, sits at $4,600 per ounce, while central banks accumulate it faster than at any point since before Nixon's announcement. The experiment is still running. I've given you the history. I've given you the data. I've given you the framework John Exter developed to understand risk and liquidity in a world without golden anchors. What you do with this information is your choice. Some will dismiss it. They'll say the dollar has been dying for 50 years, and it's still here. They'll point to the doomsayers who've been wrong decade after decade. They'll trust that the system will continue functioning because it always has. That's one response. And honestly, it might be correct. The system has proven remarkably resilient. Others will despair. They'll feel the game is rigged, the outcome predetermined, their efforts meaningless against forces this large. They'll conclude that understanding changes nothing. That's another response, and it's understandable. But despair never helped anyone navigate uncertainty. There's a third response: understanding. Not panic, not complacency. Just clear-eyed recognition of how the system actually works, how it was designed, who benefits, who pays, and what the historical patterns suggest about where it leads. John Exter didn't predict doom. He understood the system. He positioned himself accordingly. He lived comfortably and died wealthy because he refused to pretend that paper promises were the same as physical reality. You don't need to buy gold. You don't need to sell everything and move to the woods. You don't need to do anything dramatic. You just need to understand. Understand that the purchasing power in your bank account is not guaranteed. Understand that the rules can change overnight without your consent. Understand that the people managing the world's money are hedging against possibilities they won't discuss publicly. Nixon called it temporary. 55 years later, the gold window is still closed. The debt is still growing. The experiment is still running. The only question is whether you'll understand how it ends before it does.